Hey everyone, in this video I'm going to reveal my top 23 stocks to buy right now in July. But that's not all I'm going to talk about in this video, and that's not all you will learn in this video. You'll learn why I'm picking these 23 stocks, including several factors like macroeconomic factors, changes in unemployment, changes in consumer spending behavior. Also, I'm going to include some geopolitical factors in my decision making for at least one of the stocks that I'm recommending here or picking as my top 23 stocks. There's also one big change in my list of stocks to buy right now. Of course, I've been updating this list all year long, and what you're also going to see is my portfolio performance for these specific stocks for 2024. How have I performed against the S&P 500 index, against the equal weight S&P index, and overall average return for these portfolio of stocks. So you're going to get an update on my performance to try and consider if I'm someone worth listening to when discussing stocks. Of course, performance is not the only thing to consider. As is often said, results are not always the result of good decision making. I prefer a good process for decision making rather than just focusing on the results of performance to determine if the decision making was of good reasoning. So let's jump right into these stocks right now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, in the first batch of stocks, I have the Walt Disney Company, Alphabet, NVDA, Visa, PayPal, Fiverr International, Netflix, Alibaba, Uber Technologies, Amazon, and Target. Now, some specific factors that have me choosing these stocks include, for the Walt Disney Company, the consumer that was unleashing pent-up demand for away-from-home experience. The Walt Disney Company benefited from that. Also, the Walt Disney Company, its streaming segment is becoming profitable, and that's going to drive cash flow and profit for the company, supplementing the booming theme park business. Alphabet has been my top stock to buy in 2024, actually, and that's a result of a great business model that generates lucrative profit margins, and the stock is trading at a relatively cheap valuation. NVIDIA, of course, what else do I need to say? The company is the king of artificial intelligence, and AI spending is just getting started. NVIDIA is at least a couple of steps ahead of the competition, and I like where the market is heading for artificial intelligence. Visa has been my favorite dividend stock to buy all year. I love the business model Visa employs and the competitive advantage it's built. The over 4 billion people or 4 billion cards that Visa has outstanding makes its competitive position very defensible, and it's trading at a reasonable valuation as well. PayPal is trading at roughly half the valuation of Visa, but I like PayPal for similar reasons why I like Visa. PayPal has over 400 million active accounts, not the 4 billion that Visa has, but Visa's been around much longer. PayPal specifically benefits from online spending, and consumer behavior is returning to normalized levels, which is one of the reasons I'm going to discuss a big change in my portfolio. Fiverr International, the stock is very cheap, trading at a forward price to earnings of 8.9. I like the gig economy and the macroeconomic tailwind favoring the gig economy. And additionally, I like Fiverr business model, where it runs an asset-light business model. It's just a platform that brings together contractors and purchasers of services, and Fiverr takes transaction fees from all of the transactions happening on the platform. I like that business model. You'll see me recommend or employ several stocks in my portfolio that are operating under that same business model, including Uber, which I'm going to talk about a little bit later, and eBay, which I will also discuss a little bit later as well. Netflix I like for all the same reasons I like the Walt Disney Company. because consumer behavior is shifting towards streaming content instead of watching through a satellite dish or a cable connection. And Netflix is also trading at a reasonable valuation. Netflix is the industry leader, the pioneer, and it's demonstrating skill in creating content that people love to watch. Alibaba Group stock trading at a forward price to earnings of 7.827. This is the stock I highlighted where I'll discuss some geopolitical tension. The primary reason why Alibaba stock is trading so cheaply is because of geopolitical tensions bringing down valuations for China-based stocks like Alibaba. Additionally, the Chinese economy has not recovered as robustly as the rest of the world from the economic reopening, and the property market in the region, the concerns stemming from the property market has weighed on consumer spending. Saving rates in China much higher than in the US, and that's from consumers in that region feeling like they need to save more money. And so as the economy recovers from the reopening, as consumer behavior shifts more so towards buying things instead of services, which has been very prominent in the last year or two, the Chinese economy, in my opinion, will recover to growing at a relatively stronger rate, which will be good for Alibaba. Uber, I already talked about. I love the platform business model. It just takes a transaction fee from all of the rides and food that's ordered on its website. It doesn't actually own any of the food. It doesn't actually employ any of the workers. They are contractors. They only get paid if they provide service. And so I like that business model. I like Uber's valuation. Amazon is one of the stocks I've liked because of excellent execution, a great management team that has employed the business model to perfection. And this is one reason Amazon's profit margins have been increasing while revenue growth remains double digits, recovering in the AWS cloud segment, and Amazon also benefiting from the rising effectiveness of artificial intelligence. Target is another company I've liked because of good management, good capital allocation decisions from management. The Target team has, in the last, I want to say 7 years, spent over $20 billion in upgrading the business. For one, they upgraded the store locations, making it more attractive, which has resulted in more consumers visiting Target stores. And the second investment was in same-day services that has been proven very successful. Buying online and picking up your order in a Target parking lot where a employee will bring the order to your vehicle has proven to be very popular among consumers, and Target is benefiting as a result. That's the primary reason I've liked Target stock, along with its relatively inexpensive valuation of 14. Now, the next group of stocks include eBay, which employs that asset-light business model I discussed earlier with Uber and Fiverr. I really like the asset-light business model because it generates good profits from relatively fewer investments into the business. And that means the profits that the business generates can be returned to shareholders, and they don't need to keep plowing money back into the business, which then never throws off cash flow to investors, right? If you keep putting money back into the business, when do investors get their money back? And so that's a concern for some businesses that are asset intensive, that don't deliver returns on those big asset investments. That's why you won't see me recommending or highlighting any car companies in my top lists of stock to buy. Car companies, especially EV companies, are very capital intensive. They always need to be putting billions and billions of dollars back into research and development, in manufacturing expansion and updating, and that leaves little profits to return to shareholders. So I not like that business model. The next stock on the list is Zoom Video Communication. I like this stock for two reasons. Number one, billions of people learned how to use Zoom Video Communication. They have the app on their computers, on their phones, on their tablets, on their laptops, and this install base is critical when you're running a business like Zoom video communication. I know I've heard a lot about competition and Microsoft Teams and other services that are better than Zoom video, but what Zoom video has that the other ones don't is that install base, that billions over hundreds of millions of consumers, hundreds of millions of people that have used Zoom video, where Microsoft Teams, they don't have that established base of people that have used the app. And so that's an advantage. I think it's underrated right now. Along with Zoom still generates great profit margins. Revenue growth has slowed down, but it still generates good cash flow and good profits, and it sells at a relatively cheap valuation. Chewy has been on my list all year. It's now trading at a forward PE of 24. In recent days, Chewy has turned into a meme stock, which I don't quite know how I feel about that yet. I want to do a little more research into that. The meme stock area is not one where I have a lot of expertise in. I've followed, GameStop and AMC and the results of those companies and how that's impacted shareholders. Chewy is a new one that's getting included in that list now that Keith Gill, the investor that had hyped up GameStop, is now in Chewy. And so I need to do a little more research on how that's going to impact Chewy. But I've liked Chewy before all of this. Chewy's been on my list all year long. I've liked Chewy because of the relatively cheap valuation, the good profit margin, and a good management team that has boosted profitability of the company. Meta Platforms, similar reason why I like Meta Platforms to why I liked Alphabet, because of the business model, advertising, social media. It's a lucrative business model. Meta Platforms generates great profits and the valuation is relatively cheap here. AMD, I like for similar reasons why I like NVIDIA, and NVIDIA doesn't have the exposure that AMD has to the personal computer market. AMD's position in that market that's in the middle of a great reset, a great replacement cycle, I've liked for those reasons. And of course, the artificial intelligence. Businesses need GPUs. NVIDIA is not able to supply all the GPUs that people need. They're going to want someone else to be playing in that space. AMD is in a good position to benefit from that trend. Snap, again, similar why I like Snap as to why I like Meta Platforms and Alphabet, so I won't go into any more detail there. Coca-Cola, I've liked because of the habitual nature of its product. People buy Coca-Cola regardless if they have a job or if they don't have a job, if they're getting promotion or not getting promotion. It's been around for a century or more, and it's learned how to effectively deliver its product to consumers and generate great profits on the back of that business model. The Home Depot, trading at a forward PE of 20. The Home Depot has recovered from the change in consumer behavior. Remember, during the early stages of the pandemic, Home Depot benefited from the rise in home improvement spending, and then there was a reversal of that trend. And so now you're able to get Home Depot stock at a relatively cheap valuation because of the ups and downs of the recent 4 years in the business. Longer term, I think Home Depot is a great business and you're able to get it at a good valuation now. Six Flags Entertainment Corp is the big change here. I'm taking Six Flags off of my list. It's been on my list of top stocks to buy all year. I'm taking it off of the list today, starting July. The company has delivered excellent performance so far in 2024. It's up over 35%. And I think that's enough. I think it's a good time to take Six Flags off of my list because consumer behavior, remember I said, is normalizing. They were unleashing that pent-up demand. And now they've kind of had enough. They're changing back to buying more things. The next one on the list, Salesforce, trading at a forward PE of 23. The enterprise spending rebound has recovered. Businesses were fearful in early 2023 because of a recession potential, but that has since gone away and businesses are increasing spending, and enterprise management, customer relationship management is an area of good investment. And finally, Nike. Nike delivered disappointing earnings results that sent the stock price down recently. I've kept Nike on my list of top stocks to buy, but if I was to say another stock that's at risk of getting removed from my list, it's now Nike. Six Flags already was removed. Nike is on my watch list now. It could potentially be removed soon if it doesn't show some improvement over the next quarter in reflecting the business model. Okay, so now let's look at the results. All right, so I'm not going to go through each one of the results here, but clearly NVIDIA has been my best performing stock for the year. It's up 151%. I did want to show my results on screen because I'm going to take these and I'm going to show you my results and how they've performed against the S&P 500 index and the equal weight index. So here's the performance. The worst performing stock on this list is Fiverr at negative 17.89%. In my second batch of stocks, the best performer is Meta at 42.6%. And then let me share with you the results of the S&P 500, which is up 15% for the year, and the equal weight index is up 4% on the year. All right, now, if you look at my portfolio performance, it's up 13.46% on the year. The S&P equal weight index is only up 4.16% on the year. So I've outperformed the equal weight index by more than 3x. And this is the portfolio I would most informatively compare with because all of my stocks are equal weighted here. NVIDIA has returned 151%, but I'm not giving NVIDIA greater weight than any of the other investments shown here. So the S&P 500 index overall overweights the performance from large cap stocks like NVIDIA and Apple and Alphabet, which I don't overweight in my selections here. However, if you compare with the S&P, I'm trailing slightly at 13.46% versus 15.32%. Additionally, I failed to mention two stocks that are also on my list. Micron, which I added in March, is up 38% so far, and I still have it on my list of top stocks to buy. And UiPath, which I added in May, is down 33% since I recommended or since I placed it in my list of top stocks to buy. I've included those two in my results here at 38% and 33%. So there you have it. There's my list of top 23 stocks to buy in 2024 in July, and I'm removing Six Flags stock from my list as of July 1 because of the already excellent performance. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.